Hello, and welcome to the Regulatory Policy Panel. My name's Mike Pivovar, and I'm a Distinguished Policy Fellow at the Center for Financial Markets and Policy. It's my pleasure to moderate today's discussion with two members of the U.S. Securities and Exchange Commission. Commissioner Hester Peirce has been a commissioner since January 2018. Commissioner Allison Herron-Lee has been a commissioner since July 2019 and served as acting chair earlier this year. Commissioner Peirce and Commissioner Lee, welcome, and let's get right to the discussion. At the commission, the chairman sets the overall agenda, but individual commissioners can focus on individual areas of interest and can influence the direction of the commission in those areas. Chairman Gensler set a very aggressive agenda, and he's directed the staff to look at a number of different areas. Commissioner Peirce, let me start with you. Throughout your term, you've been a strong advocate for promoting capital formation, one of the three parts of the SEC's mission. Will this continue to be the main focus of your term? And what specific areas of capital formation do you believe are in need of improvement? And outside of capital formation, what other areas would you like to focus on?
Thanks, Mike. It's great to be here, and it's especially wonderful to be here with Commissioner Lee. So I have to start with a disclaimer, which I think goes for both of us, which is that our views represent our own views, not necessarily those of the commission or our fellow commissioners. Capital formation will continue to be an important priority for me. I think there's still work that we can do in that area. Specifically, I think there are some rules we could create a micro offering exemption for very small companies, very small offerings. And we also need to do something about secondary trading, preempting secondary trading from state regulation to make some of our other exemptions work better. So those are a couple ideas there. I also continue to think that it's important to broaden the accredited investor definition, make it easier for set up a regime for finders. So those are a couple other ideas. And then hope that we'll put in some kind of a regulatory regime around crypto to allow for easier innovation with a clear understanding of what the rules are. And then finally, the SEC is always faced with just thinking about building blocks type things, making sure that the market structure and the equity markets and the fixed income markets is working appropriately. And I think those are both issues that Chair Gensler has said are important issues. So those are some things I'm thinking about as well. And also appreciate the fact that given his interest in technology, I think he has an interest in making sure that our rule book accommodates and recognizes that there are new technologies that are being used. And so I'm looking forward to working with him on those issues as well.
Great. We'll revisit throughout this conversation. You mentioned crypto as one particular area and some market structure issues. We'll get to those. Commissioner Lee, let me turn to you now. Throughout your term, you've been a strong advocate for the investor protection part of the SEC's mission. Will this continue to be the main focus of your term? What specific areas of investor protections are you particularly interested in? And outside of those issues, what other areas would you like to focus on?
Well, first, let me also say thank you for having me today. And it really is a pleasure to be here with Commissioner Peirce. I will say that we've had many discussions offline, and they're always challenging, they're always interesting, and I always learn from her. So I appreciate the chance to be here today and talk with her and you. I'll start with this. I'll say that I actually don't think there are any areas of our jurisdiction that can fairly be described as wholly outside of investor protection. I mean, if you look at the 33 Act, the 34 Act, you see that phrase hundreds of times, along with in the public interest. In the public interest and for the protection of investors, that's our kind of our core mission. So I don't really juxtapose that with capital formation. All of the topics that Commissioner Peirce just listed are extremely important, but in my view, they all start with strong investor protection, and that is what I think helps for strong capital formation. When we say, as we often hear, that we have the deepest, the most robust and liquid capital markets in the world, we know we also have the strongest investor protections, or in many instances we do. And I don't think that's a coincidence. I think the two go hand in hand. So that is sort of to say, yes, I have placed my focus on investor protection. I think that is a key pillar of our mission, but it is also what underpins and leads to strong capital formation. Now, you asked about priorities. I think it's no secret that I've made a priority of trying to help investors and companies and funds in dealing with the risks and opportunities presented by climate change in our financial markets. But I gather we may go into that a bit later, so I won't expand on that here. I will add that I have been and I will continue to be interested in considering the balance between capital raising in our public markets and capital raising in our private markets, and how the policy choices that we make influence that balance. Because I do have some concerns that we've steadily made changes and declined to make others within the private market regulatory space that have resulted in facilitating the trend that we've seen toward more capital being raised in private markets. I note that Commissioner Peirce just referred to expanding the accredited investor definition, and I was not opposed to the changes we made there to sort of encompass sophistication by adding certain financial intermediaries and the like. That made sense to me. What I was concerned about there was not updating the wealth thresholds. If we're trying to use something as a proxy for sophistication, the sort of the idea of roping in financial intermediaries made sense to me, but not letting the thresholds stay the same for 40 years, the wealth threshold. So I would like to see us take a look at that. And hopefully maybe there's some middle ground there. But one other final area that I think is worth noting is we made a proposal back in 2013 to update Form D, and I'd really like to see us finish that so that we have better information about what's happening in the private markets, about how much capital is being raised, what exemptions are being used, which ones are useful, which ones are not. And then, so I think that's another important priority. And I did give a speech last month, it's last month now, it's November, connected to 12G, which is the sort of the dividing line, what will trigger a company having to do ongoing reporting obligations. And I think we need to look at how we've defined what it means to be a shareholder of record in that space. So that's just a few priorities that I would like to see the Commission focus on, although we have a big and ambitious agenda right now. So I'm pleased to see that.
Yeah, great. Let's follow up on one of those that you mentioned. You had mentioned climate risk. So let's go with that. So Chairman Gensler has said that the Commission staff is busy working on a rule proposal that would enhance disclosures by public companies of climate and environmental, social, and governance, or ESG information. Now, this is an issue that the Commission has struggled with for years. Commissioner Lee, as you mentioned, you said that you believe this is an important issue for the Commission to address sooner rather than later. Could you lay out your thoughts as to why you think it's so important?
Sure. I'll start with this. I'm taking my cues from investors here and other market participants, and we've been hearing overwhelmingly and in no uncertain terms and with increasing urgency that the Commission needs to act in this space with respect to climate risk in particular. I think investors are clear about the urgency there. There's a fundamentally important role of the Commission, which is to help ensure that useful information gets into the markets in a timely manner so that investors can accurately price risk and allocate capital as they deem appropriate. And here, we have guidance in the climate risk area, which is what's on the regulatory agenda, climate risk and human capital. And we have guidance in the climate space that's now 11 years old. So a lot has changed in that time. And there has also been a tremendous increase in the disclosure since then. The quantity and the quality of climate disclosure, I think, has increased significantly in the last decade or so. And that's in large part because of the efforts of investors in seeking that disclosure and issuers in responding to that demand, and voluntary framework and standard setters to sort of facilitate that disclosure. But I think that we have reached the limits of the voluntary efforts at this point. And we're now in a place where regulatory involvement is needed, but can also add real value in the capital markets to ensure consistent, comparable, reliable disclosure, and also to provide everyone some certainty, including especially issuers, as to what's required of them. I think climate is unique somewhat in its urgent nature and its potentially systemic implications. But you mentioned ESG more broadly, and again, I'll just say what's on the agenda is climate risk and human capital. ESG is there with respect, I think, to funds and fund advisors. But in any case, there is an increasing recognition that there's a range of other ESG issues that are important to investors, but that's a tougher space. And Commissioner Peirce has made some really good points, I think, about kind of how ill-defined that space is and how difficult it might be. But I think the urgency, I support trying to kind of refine that better and get to a better place than we are right now on ESG. But I think the climate piece is pretty urgent.
Yeah. Okay. Thanks. So, Commissioner Peirce, you did not list this as one of your priorities for the commission, and as Commissioner Lee mentioned, you have concerns about broader ESG disclosures, but in climate in particular. What are those concerns that you have with the commission moving in this space?
Well, I did not list it as a priority for me, but it is a priority for the commission. As Commissioner Lee mentioned, it is something that's happening and that's being worked on. And so my concern is that for me, the touchstone of disclosure is materiality, and that's what's material to an investor trying to assess the long-term financial value of a company. And certain climate risks may well be material and should already be disclosed, but I don't think that there's a common set of metrics across every company, across every industry, that is by default material. And so what I would argue is if we start prescribing, we're going to be getting uniform disclosure that may not actually be reliable, comparable, accurate, or material. And so that's not the direction that I would like to go. That said, we'll see what the proposal comes out looking like. I think we have gotten a lot of helpful input already. When she was acting chair, Commissioner Lee put out a request for comment, and we actually have gotten quite a bit of response to that request for comment with some really thoughtful ideas about how we should approach climate change disclosure. And so that, I think, is informing our proposal and will help us at least have the proposal in shape to get another round of good comments. And so I look forward to seeing what people have to say, but I'm quite skeptical that we need to have a specific set of climate metrics in our securities laws.
All right, thanks. Let's turn to digital assets, also known as cryptocurrencies. So, Commissioner Peirce, you mentioned this as one of your priorities. And to set the stage here, so folks in the audience can think about these issues or frame it. So, virtually all digital assets seem to fit within the legal definition of commodity under the Commodity Exchange Act. So that means they generally fall under the jurisdiction of the Commodity Future Trading Commission, or CFTC, unless they also meet the legal definition of a security, which means they fall under the jurisdiction of the SEC. So far, the SEC's preferred tool for determining whether a digital asset is a security is something called the Howey test, which is actually based on a 1946 Supreme Court decision involving leaseback arrangements for orange groves. And digital asset market participants have said, well, we need an updated lens for this to provide legal and regulatory clarity. And many have argued that the Howey test is ill-suited for digital assets. So, Commissioner Peirce, let me go to you first, since you are known as Crypto Mom, for your efforts to provide legal and regulatory certainty for digital assets. Why is this issue so important to you, and what is your preferred approach?
Well, you're sounding less like an economist and more like a lawyer in asking that question. But that, I think, is true of the crypto world too. Everyone is becoming very familiar with Supreme Court precedent in the crypto world. I have argued that I think there's a lot of uncertainty around how securities definitions and laws should apply in the crypto space, and I continue to believe that's the case. We at the SEC have taken a very enforcement-centric approach where we say, well, everything really looks like a security to us, and so we're bringing these enforcement actions. And what I hear from people in the space is we want to find a way to comply with the law, but we want to do it in a way that allows us to continue to develop this technology, which we think has great promise, not only in democratizing access to the financial system, but in developing a whole set of new ways of doing things. So the distributed ledger technology is a really powerful way of organizing people to work together to build things and to run things for their own benefit. So you can imagine social networks running on a decentralized network as well as financial applications. So I'm concerned that if we don't provide a sound framework within which this can happen, a lot of the innovation will happen outside of the United States. People will avoid doing business, interacting with US persons, and that's going to be to our net detriment. So why not instead come up with a framework that addresses some of the concerns that the securities laws are intended to address? So if someone is developing a network, for example, you want to know what are the person's plans for developing the network, what are the tokens, what are the economics around the tokens. You want to see that code out there publicly so we can address these information asymmetry concerns, but do so in a way that's more tailored for this space. So that's something I've suggested, but I'm open to other ways of providing clarity. I just think we need to do it through some means other than enforcement actions.
All right, thanks. Commissioner Lee, how are you thinking about this issue?
Well, let me start by saying I understand and appreciate the concerns that Commissioner Peirce has raised, and also appreciate very much her deep focus on these issues. I've learned, as I said before earlier, I've learned a lot from her about this space and some of these issues. Here's where we may part ways just a little bit, and that is, I don't think that we ought to single out any particular product or market segment like cryptocurrencies for kind of special treatment under the securities laws. We always say we don't pick winners and losers, and that is true in this space too. Now, if Congress weighs in and identifies some specific regime applicable to some or all of these assets, then so be it. They will have spoken, but for now, the Howey test is a principles-based test for determining whether any given investment opportunity presents the sorts of risks that the Securities Act and the other securities laws were designed to address. And so the market for digital assets and the technology underlying them, it's evolving rapidly. And we may not always anticipate all the ways in which securities laws will apply to new products in that space, but it's no different than any other, when we're trying to figure out if an orange grove, the way they're selling an orange grove has implicated the securities laws. And so it's also the case that our staff in our we have a new office, it's new-ish over the last couple of years, FinHub, we have CorpFin, they're all available to engage with issuers in the space in advance of an offering so that they can get engagement on some of these questions prior to potentially running afoul of the securities laws. And I will say that the disclosure requirements that come along with registration are designed to provide investors with critical information that they need when they're faced with an investment decision. And investors in digital asset securities are no less in need of that information, in my view, than investors in any other kinds of securities. Also, I think much of the digital asset space continues to present a really wide range of other regulatory concerns, in addition to registration issues, as it relates to market manipulation, money laundering, illicit finance, and tax avoidance. These are all issues that are kind of implicated that we need to make sure we're focused on. Here in the US, again, we have these large, robust, innovative capital markets, and I think that's in large part, because of the strong oversight, and our focus on protecting investors means that the people and the institutions here can have confidence in our markets. I think we have to evolve with changing technologies, but I don't think that means we change our principles or stray from our mission, which I think has worked well for decades. So I welcome again, I'm open to, and I appreciate the focus that in particular Commissioner Peirce has brought here. I'm open to looking at and thinking about potential areas here, but I do think we have to be careful not to stray from our tried and true mission and treat these assets differently. We need to help make sure that innovation can flourish just as we have in other spaces. But I don't think we should relieve them of the protections that are there for investors in every other space.
Yeah, so Commissioner Lee, you mentioned, there's the cryptocurrency market is constantly evolving. One of the more recent trends we've seen is the development of stable coins, which are a type of digital asset that are designed to maintain a stable value rather relative to a particular currency such as the US dollar. And recently, the President's Working Group in Financial Markets, which is a working group of federal financial regulators, including the SEC, released its long-awaited report on stablecoins. And in the report, they identified a number of potential risks of stablecoins, including run risks, payment system risks, systemic risk, and economic concentration risks. So I want to ask each of you, in your views, what did the PWG stablecoin report get right? What did it get wrong? And what is missing? And Commissioner Lee, let me just stay with you on this.
Sure. I was very glad to see that report, which was just this week, I think came out, and I think it's important for the public to know that financial regulatory agencies and the administration are thinking critically about these issues and trying to calibrate approaches to this evolving space. I think the report was correct to point out that despite aspirations for broader use as a means of payment, stablecoins today are overwhelmingly used to facilitate trading, lending, and borrowing of other digital assets. That is the use right now. And many of those transactions, I think, are highly speculative in nature. And the report called on Congress to provide banking agencies with certain new authorities. And it was clear that many of the products and activities in the space, though, are already covered by the federal securities laws and fall within existing jurisdiction at the SEC and at the CFTC. So they did flag a number of ways in which stable coins and related products and activities lack some important protections applicable to their registered counterparts. So there are no consistent standards for the quality or the type of reserve assets that support the price of these various stable coins, and the level of disclosure about those reserves varies pretty widely. That's a key distinction from registered money market funds, where rules impose critical disclosure and liquidity and other requirements that are designed to promote transparency and mitigate the potential for runs and other risks. So many stablecoin issuers purport to custody their reserve assets at FDIC insured institutions. It's unclear whether and to what extent that protection extends to the holders of the stablecoins themselves. And I think it's also important to remember that the report was not meant to be an exhaustive treatment of stablecoins or the relevant risks. It's limited in scope to identifying specific risks, for the most part related to payment systems and systemic risk. That's an important contribution to the ongoing conversation, but it doesn't cover the entire waterfront, and I don't think it was meant to. But let me stop there, because I'd like to hear from Commissioner Peirce on this too. So,
yeah, we all would. Commissioner Peirce, what did he get right? What did he get wrong? What's missing?
Well, I think Commissioner Lee is right on the point that it was a limited report in terms of it primarily focused on payments aspects, and viewing stablecoins as primarily a banking activity, I think is the correct way to look at things. It doesn't mean that there aren't potential securities laws implications around stablecoins. Stablecoins are not all created equal, designed differently, and some of those designs may implicate the securities laws. When I approach the issue of stablecoins, I say it's important for us to recognize that people are using these and find them valuable. So whatever we do on the regulatory side should do its best to preserve the usefulness, the utility of stablecoins. I think they may end up being a much more attractive option for the United States than a central bank digital currency. It's kind of the private sector alternative. It allows for more competition. It allows for better way to respect people's privacy. So I think the report was a good step. As Commissioner Lee said, it really is important for people to know that that the government is paying attention to this, to the development of stablecoins. They've risen rapidly in popularity and in use. And so it is something that we need to pay attention to. And I think there's still a lot more work to be done in that space, but I hope we develop a sensible regulatory regime.
Great. So let's turn to market structure and market infrastructure issues. So Commissioner Peirce, you mentioned market structure issues as one of your priorities. Recently, the Commission staff released its staff report on the equity and options market structure conditions in early 2021 in response to the so-called trading frenzy in the so-called meme stocks earlier this year. Commissioner Peirce, you and Commissioner Roisman released a statement criticizing some aspects of that report. Before we get to your criticism, what did you think the report got right? And then what were your criticisms of the report?
Well, I think the report laid out kind of the chronology of what happened and was useful and provided some context around that, which is useful. But the concern that I had is that we really can't draw regulatory conclusions from what was laid out in that report. That's a much bigger project to try to figure out if there are regulatory changes that need to be made. I mean, I think there's some things that, of course, we're looking at. Is there a way to shorten the settlement cycle, which is something that I know the Commission worked on when you were at the Commission and made progress in shortening it? Can we make further progress in shortening that cycle? It's always a good way to pull risk out of the system by making settlement happen more quickly. You have to do it carefully, of course. And then there are other issues that we may want to take a look at. This was a real instance of active retail participation in the markets. Perhaps that trend is not going to continue post-pandemic. But I think there's a real positive aspect to active retail participation in the markets. We want them to do that in a way. We want retail investors to be informed and careful and educated as they enter these markets, but it is a good thing to see them participating. So whatever we do in this space, I hope we don't make the situation for the retail investor worse than it is now, because I think retail investors have a really, it's better for them in the markets now than it ever has been. So we want to make sure that whatever we do doesn't compromise the advances that have been made for retail investors. And then another thing I would say is that we spend a lot of time thinking about the equity markets, but we probably also need to remember that there's work to be done in the fixed income markets. There's modernization that could happen there that would really be advantageous for retail investors. So I hope we'll spend some time thinking about that, and I suspect we will under Chair Gensler.
Sure. So Commissioner Lee, Commissioner Peirce laid out some areas of potential working together. But first, let me get your response. What did you think of the report that the staff released? What did it get right? Any criticisms of it?
So I will start with an agreement with Commissioner Peirce on the need to focus on the retail investor experience in this space. So I was glad to see the report come out. I think it showed the facts and the information that we were able to sort of share publicly. And what we did see was an increase in retail participation in equity and in options markets, and an increase in the number of retail investors participating in the markets, with brokerages, in some cases reporting substantial growth in account openings, by some measures exceeding 10 million new accounts in 2020 alone, and a shift in the nature of that participation. So there was a decrease in the average age and the average account size of investors. It shows a growing number of firms that are using mobile investing apps and digital platforms to interact with investors, especially retail investors. And of course, many of those apps offer trading with no commission and no minimum account balances. And I think it also showed the vast majority of retail order flow in GameStop in particular being purchased by wholesalers and executed off exchange. Like something like 80% of the GameStop trades were internalized and executed off exchange in January of 2021. And what's more, that internalization was highly concentrated around the nature of maybe 90% or so of the internalized dollar volume in January was executed by 3 wholesalers. So that's some of what was in there. That's a lot. Now, as for the recommendations, the report didn't really have recommendations. I mean, it pointed to policy areas that merit additional study or consideration. That included looking at broker trading restrictions of the type that we saw, during this volatility, looking at digital engagement practices by some of these online brokers, payment for order flow, dark pool, and wholesaler trading, short selling dynamics. Commissioner Peirce mentions the settlement cycle. Definitely something I'm glad to see that we're going to see some focus on that. I think that's an area that was implicated where markets could certainly benefit from additional changes there. I think another area that we ought to examine is how these online apps and platforms are dealing with their customers and whether they're complying with relevant regulations. So, are these apps and platforms, when they seek to influence trading behavior, have they triggered Reg BI? That trigger, happens broadly when a recommendation is made. That's going to be a facts and circumstances analysis. But one of the factors that we look at in that analysis is whether, what the communication can reasonably be viewed as a call to action, or whether it would reasonably influence an investor to trade a particular security or group of securities. So I think those are all issues that we should be looking at and thinking about. The report doesn't make recommendations, any of that. Those are policy considerations for the Commission on an ongoing going forward basis, and I hope that we'll dig into some of those.
Great, yeah, a lot on the agenda. And Commissioner Peirce, thank you for mentioning that we worked to shorten the trade settlement cycle. When I was at the Commission, at the time I was acting chairman, we were down to a 2-person commission, and so by definition, anything we had to do had to have bipartisan support. Both of us had to vote for it, and it was something that Commissioner Stein and I spent a lot of time trying to get that forward, and we got us to T+2 based on a cost-benefit analysis at the time. But we knew technology would change and markets would change over time. And so we built into that final rule a study by the staff that was due to the Commission last September. Some of us have called for the release for that report, but we're hopeful that you will move in that area. And I know that whether you go to T1 or T0 or T midnight or whatever it is going to be based on thoughtful analysis. In terms of other areas of potential bipartisan support for market structure issues are ones where you can look for that. Commissioner Peirce had mentioned short selling disclosures, or maybe whether it's either in real-time reporting or in the securities lending market. You both mentioned trade settlement cycle, looking at payment for order flow, and then Commissioner Peirce also mentioned the fixed income market. So in our last 2 minutes remaining, so Commissioner Lee, any of those areas that you think are fruitful for good bipartisan support within the Commission?
I hope all of them. I think it's important for us to work as hard as we can to get to the best solutions in these spaces. As I said, I think T+ or the shortening the settlement cycle shows some real promise for unanimous outcomes there. I think we're going to need industry participation there as well, some of which I think has already begun to occur. We learned a lot from what you were able to accomplish when moving to T+2. So we sort of know what needs to happen there in a way that we wouldn't otherwise. So that's a place where I'm quite hopeful that we can reach a unanimous decision. I think fixed income markets, I agree with Commissioner Peirce. That's an area that needs a fair amount of focus, and hopefully is another area where we can get to a better result because we will potentially have a unanimous agreement on it. And working to get there will almost always ensure a better outcome, as I know you and Commissioner Stein did many times during your tenure. So, but again, I think it should be the goal in every instance.
Great, thanks. Commissioner Peirce, last words on that, market structure issues?
I think there's lots of room for good joint work on those kinds of issues. We all care about the functioning of the markets. We all know that we have a real treasure in our capital markets, and we want to keep them working as efficiently and effectively as possible, and want to make sure that they're being used by as many people in the United States as possible, both as investors and as founders drawing on those capital markets to build their businesses. I think that's something that we can all agree on.
Great, and we'll end it there. So Commissioner Lee, Commissioner Peirce, thank you so much for taking time out of your, your valuable time out of your I know you're very busy these days, so we appreciate you taking the time and sharing your insights. So thank you.
Thanks for having us.
Thank you.